So we are currently 69% overvalued. How does that affect stock prices? It's a very, very understandable and reasonable question. Yeah. So you are making gains over the next 10 years, but is that really worth it? I'm okay with that. Okay, guys, April's finished. We got the updated first quarter GDP numbers. So how does that affect stock prices? Mo?
It probably went up a ton.
So Mo's very bitter at the world. He gets very angry when he sees stocks go up. I just laugh about it.
Everything's green today.
Everything is green today.
Do you think that it's just stuck in green on our software, maybe?
You know what's funny? I hit refresh because of that. I was like, wait a second, is our software just glitchy right now? I'm like, no, it's not. So guys, Warren Buffett says the most reliable indicator of stock market valuations at any given time is the stock market to GDP ratio. What this does, it takes the market cap of the stock market, divides it by total US GDP. If you think about it, it makes sense because as GDP rises, which is the total income of the US, the businesses within the US should go up. So some sort of ratio involving the top companies should exist. So what I did, I made it based on the S&P 500, okay? And every morning in our software, in our community, I report the new stock market to GDP ratio. So this is it going back to 1929. The S&P 500 didn't exist back in 1929, but the equivalent of it, Schiller was able to find that from his website, so I pulled all his data. The March 31st, 2023, I got to put that in there, it's not 2022, GDP was 26.47 trillion. The S&P 500 is a market cap based index, so figuring out some ratio here is very easy. The ratio is currently 1.575, okay? Historically, the average has been, you go here to the right, 0.93. So we are currently 69% overvalued. That's a lot. But is it a lot? Well, we don't know. Because last year, or 2 years ago, it was 103.4 was the peak at the end of the quarter. I think within the quarter, we hit 107.7%. That's over double what it should be, okay? Now, here's the scary part. I went back, and not including dividends, the average 10-year return is about 6.6%. Include dividends in there, it's between 9 and 10%. When you're over 40 or 50% or more, 37 times that happened, the average return over the next 10 years is negative 0.5%, not including dividends. Dividends are currently 1.4%, 1.3%. So you are making gains over the next 10 years, but is that really worth it? Now, am I telling you not to invest in stocks? Mo, am I saying that?
No, not at all.
So if somebody were to say to you, like they do in the comments, well, Paul, if you're saying this, why should I invest in stocks? And it's a very, very understandable and reasonable question. Yeah. What do you say to them, Mo?
Dollar cost average in ETFs.
Why is that?
Because you're going to get an average of 10% over a long period of time. That's your goal. Your goal is not to do 20% per year. At least, and it shouldn't be.
Take the thinking out of it.
Yeah.
With dollar cost averaging, you're taking the thinking out.
You're going to buy sometimes when it's way overvalued, sometimes when it's way undervalued, and you'll be right on that line in the middle.
So this is the line of value. Let's call this fair value. But over time, here's what happens with Mr. Market's prices. Up and down. Sometimes you're over, sometimes you're undervalued. But if you dollar cost average, you never have to guess. Now, the other reason I tell people, and over a long period of time, this will be your average paid. You can beat the stock market MBAs, the Harvard MBAs at their own game because they're buying and selling all the time.
They have to.
I saw a tweet today, and by the way, follow me on Twitter if you down below. I saw a tweet today where a guy goes, the best investors of all time don't dollar cost average in ETFs. Millionaires don't do it, so you shouldn't either. And I'm like, this is the worst tweet ever.
Millionaires do
it. Millionaires do it, and the ones who don't do well.
Correct.
Okay, and the reason the best investors of all time don't do it is because they're the best investors. They can pick individual companies.
Exactly right.
And you can pick individual companies, but it takes a good foundation and emotional aptitude to be able to do that.
And do it with a small percentage of your portfolio. Maybe do it with 5-10%, but
that's
not
how we
any
started.
More than that. Yeah.
I was 100% ETF, and then I was like, you know what? I think I can pick individual stocks. I picked 5 or 10% of my money, then 20, then 30, and finally I'm like, you know what? I'm 100% my own picks. I'm okay with that. But I didn't start with 100% me picking my own money. I went to ETFs, and then I slowly started to get into it. Right?
Yeah, it's the way to do it.
That's the key here, guys. That's the key. And when you look at this, when you look at these numbers and you look at the history, these are where we stand in the stock market. This is the chart going back to 1929. This is the chart. This is the next 10 years returns. This is the valuation, the ratio. As the ratio gets higher, returns go lower. And we're at a very big outlier here right now. Where are we right now? We're at right here. We're in this area right here, right? Guys, it's not going to be pretty, and that's okay. And here's another reason why. You should dollar cost average. Look how long we've been overvalued for. We've been overvalued since March 2013, but GDP has gone up along the way. GDP went from 16.6 trillion to 26.47. Now, are we at the extremes? Yes, but look how long we've been over 30% overvalued since March 2017. That's the mistake I've been making. I started selling back then, and I was out of stocks completely in like 2018, 2019, out of stocks completely. So I've lost a lot, but I was able to make money from puts and other things like that were fine. I have real estate, I have businesses upstairs. So I was still able to grow my net worth. You don't have that ability necessarily. You can't make these guessing games. They'll cost you too much money. So your job should be the dollar cost average month in and month out. And if you want to pick individual stocks, subscribe to our channel, subscribe to our software. Go ahead, Mo.
Also, when it comes to picking individual stocks, just because that is that overvalued doesn't mean that everything is. There are still good stocks out there. There's still good companies out there that are at a good value because they're mispriced right now. But the majority of them are not.
Correct. I've made purchases this morning.
So did I.
Listen, but I'm fully aware that the purchases I made are probably, and I hope, going to go down because it'll allow me to buy more shares at a cheaper price, right? I'd rather be able to deploy that capital at lower prices than have the small purchases I made today go up. That's the key. But I don't know when they're going to stop going up. I don't know when they'll stop going down. Yep. I just buy when it's a good deal.
Yep.
That's the big key here. But I want you to remember, it's going to be a very bumpy road for a while. We're 69.2% overvalued with the updated GDP number that came in. That's tough, guys. That's really, really tough. It's a hard world, but guess what? If your outlook is 20 plus years, you shouldn't even worry about this. If your outlook is less than 10, yeah, I'd be a little concerned. I'm not trying to put fear in you, but I would start understanding what your money could do over the next 10 years. It'll probably be even or up a little bit with dividends. Are you okay with those fluctuations? You have to be emotionally okay with the fluctuations, knowing that the next 10 years, as you add money into your portfolios, into your ETFs, when it's low, you'll be getting great, great deals. That's the big key here. So guys, if you like this, subscribe to the channel, share this with somebody you know. We do these updates regularly because we want to talk about these valuation metrics. No other financial idiots out there on YouTube are talking about this because they're all morons. Don't be a moron. Thank you very much. Take care.